Hello, fellow Rebel Capitals. Hope you're well. So we had new jobs data come out today. It's not the non-farm payrolls. We're going to get that Friday. And I want to talk about that in a moment. But we had the ADP numbers come out today. And wow, what a miss. In fact, I don't want to explain it any further. Let's get right into the headlines and you guys will see what I'm talking about. I want to shoot over to, well, let's go to the ADP website itself. This PDF pretty much sums it up here. So ADP National Employment Report, private sector employment increased by 37,000 jobs. You say, okay, well, that sounds pretty good. 37,000 is a lot. Not in an economy with 350 million people. So the next question is, well, what was the market expecting? And let's shoot over to the Market Watch calendar. I always like to use on these videos. And we can see right here, ADP employment number. Market was expecting 110,000. Oh, you get the old Homer Simpson right there. And last month got revised down from, I believe it was 62,000 to 60,000. And then this month, a huge miss. I mean, that is massive. We go from 110,000 expectations down to 37,000. And who knows, that might even get revised down next month. So another thing that I want to talk about today that piggybacks on this extremely weak jobs report is the Fed's Beige book. Maybe you can see that right here. That just came out. Call it an hour and 15 minutes ago, an hour and a half ago. And I want to just go over the executive summary here because that's going to give us more insights as to what is happening with the real economy. I forget the stock market, forget all these other things. As you guys know, the stock market isn't a good reflection of the underlying economy. In fact, there's often an inverse relationship, especially when we get into this mode where bad news is good news because it means the Fed is going to cut rates. And as soon as we go over to the Beige book, then we're going to go over and see how markets are responding. As you can imagine, yields really got a bid, or I should say treasuries got a bid as a result, which begs the question, something we discuss on this channel all the time, what drives the long end of the curve? What drives rates? Is it deficits? Is it U.S. debt? Or is it growth and inflation expectations? And that is a huge, very important distinction to make, because if you acknowledge that it's growth and inflation, that completely would change your view on future rate expectations, especially at the long end. And if you land more on the side of deficits and debt, well, that would lead you to a completely different conclusion, because we all know and we can all agree where the debt is going, and that is straight up. But before I get too sidetracked, let's get right back to this ADP report that really breaks things down. So annual pay up 4.5%. And I don't know what the expectation there was, and I'm almost positive it's a nominal number. So private sector employment increased 37,000. Okay, we got that. And let's see. The ADP National Employment Report, in case you're not familiar with this, is an independent measure and high frequency view of the private sector labor market based on actual anonymized payroll data of more than 25 million U.S. employees. Okay. Let's get down to the nitty gritty here. So 37,000, here's how the change played out per sector. So goods producing, and this is what should be booming according to Trump and all the make America great with the tariffs. And I don't want to be too hard on them, because I know that there's a lag and they're doing things that will impact, or supposedly they're doing things that will impact the economy over the next 3 years, 5 years, 10 years. So, you know, we got to cut them some slack here. But the good producing, natural resource mining, it's basically a negative, except within construction. Now, this is really interesting. Construction jobs still increasing. Now, if you guys remember my indicators that I created through AI, and we're putting those up in Rebel Capitalist Pro, one of the main leading indicators was construction jobs. And this is still positive, still positive. So I want to make sure that the takeaway from this video isn't that, this is the GFC and we're in the middle of it right now. This is not a good jobs report by any stretch of the imagination, but it doesn't mean that we've gone into a quote unquote recession if you're defining that the way the NBER would. I was on a Twitter space this morning, and the way I described it is the economy right now is just kind of stuck in the mud, just kind of slogging along and not really growth. And for the majority of Americans, it's probably in recession, or at least it feels like a recession. But we're not at a point right now where the NBER comes out and says, okay, definitively, yes, here it is. Just every single Fred chart, shade it gray. You guys know that's what they do when they show a recession. But it's not like the economy is running on all 8 cylinders either. I mean, just because the car hasn't stalled yet doesn't necessarily mean that the car is running smoothly, right? Our car right now is maybe running on 2 cylinders. So when we know the car is completely stalled is, or one of the ways that we know this, is the overall labor market, but more specifically, these construction jobs. And we're still at 6,000, still at 6,000. So here we've got service providing, got negative 4,000 in transportation. Okay, this doesn't really surprise me at all. Information, financial activities, professional business services, education. I tell you what, if I was a college student right now, not that I would go to college, but if I was and I wanted a job that I knew was going to be as secure as possible, I would definitely be in, oh, I'm sorry, leisure and hospitality. I thought that was healthcare. I would definitely be in healthcare. Yeah, but we'll save that for a separate video. Leisure and hospitality, that surprised me, up 38,000. Now we get into the regions where Northeast, all negative. Midwest, decent. The South, kind of a mixture of both. The West, good. Okay, now establishment size. This is really interesting. So small establishments, almost all negative. And this makes sense because they're the ones that are going to be most disproportionately impacted by tariffs, especially with China. Medium establishments, okay, 51,000. That's big growth when you look at 50 to 249 employees. I guess big growth relatively speaking, because the whole report's just terrible. Or the overall report, I should say, is terrible. So annual pay, so job stayers, 4.5%, job changers, 7%. I wonder if that would be, I've never heard anybody talk about this, but I'll bet that would be something to look for as far as the ratio. Once the ratio goes the opposite direction, so job changers get less of a bump than job stayers, I think that would really mean something. And that would especially mean that people are going to stay in their job because they're extremely afraid to lose it, because they know that the probability of them getting a better job decreases. So then they break down the pay increases, and keep in mind, these are year over year, and these are not adjusted for inflation. So, I mean, here's an example, 2.6, when you've got small firms, 1 to 19 employees, they haven't even been able to keep up with the rate of inflation. And this makes sense because I think what we're seeing in the overall economy with the recession, if you will, really impacting the poor, the middle class the most, or them being in recession. I should say the stuck in the mud economy is impacting them to the point where they feel like they're in a recession. I think the same can be said for businesses where the big, S&P 500, well, those guys are doing fantastic. Those guys are doing great, just like the top 1% in the economy. But as you go down to the small, mid-sized businesses, they're struggling a lot more. They're not doing as well. Now let's go over to the Beige book. Let's make sure we got the screen share working. We do. Okay, here we go. So this is a report the Fed comes out with monthly. And I like this because it is anecdotal evidence, but it's boots on the ground intel. So as you guys know, there's 12 districts, and each Federal Reserve Bank within the district goes out and they do all of these surveys with local businesses, and they aggregate the data into this report. That's the Beige book. So let's look at the executive summary. We know what it is. Okay. Information collected. Okay. Got it. What am I looking at? Yes. National summary. Overall economic activity. Reports across the 12 Federal Reserve districts indicate economic activity has declined slightly. So again, it doesn't necessarily mean that we're in the heart of a recession right now. It's not the GFC yet or any of those things, but we're stuck in the mud. This economy is not even close to running on all 8 cylinders. And we may be getting closer to the point where it actually tips over into what the NBER would classify as a recession. I think a lot of this really depends on the next few payroll reports that we get, the next one being Friday. Let me write that down because I want to go over that as soon as we get done with this Beige book. Okay, getting back to it here. Half the districts reported slight to moderate declines in activity, 3 no change, and 3 reported slight growth. All districts reported elevated levels of economic and policy uncertainty, okay, no surprise there, which have led to hesitancy and a cautious approach to business and household decisions. Okay, that was even if you were very pro tariffs, I think this was your base case, and that how it would play out over the short term, even if your long-term view of tariffs was extremely positive. There was no doubt that it was going to lead to kind of people freezing because they don't really know what's going to happen next. Manufacturing activity declined slightly. Consumer spending reports were mixed, with most districts reporting slight declines. See, once the consumer stops spending, there's a reason why. It's not because the American consumer wants to save more. That's just culturally not even hardwired into our into our beings as American, unfortunately. So when you see the spending decline, this is a result of them just not having the purchasing power and just having to tighten the belt. It goes back to a tweet that I sent out the other day where I was saying, we had the savings rate go up a bit. And I'm like, okay, this means one of two things. Number one, the American consumer is so flushed with cash. They're making so much money that they can't even spend it all. And therefore they're saving. Doubt it. Or they're just saving because they can get a sense that the stuff might hit the fan, and they want to make sure that they've got something there for a rainy day. So I think it would probably be the latter. And based on this report and based on what we're seeing with ADP, I think everything is consistent here. Again, what's really going to be interesting is what plays out on Friday when we actually get the non-farm payrolls. That's what the market's really going to pay most attention to. And that, I'm not saying it will go negative. I'm not saying that at all. But if we start to see those payrolls really soften up to the point where they're way below expectations and maybe even go negative, that's when we could be tipping from the stuck in the mud over into the actual proper contraction of the economy. Okay, on balance, the outlook remains slightly pessimistic and uncertain. Okay, however, a few districts reported indicate outlook has deteriorated, while others indicate outlook has improved. All right, so mixed report, but overall, it's getting softer. Labor markets. Employment has been little changed since previous report. Most districts described employment as flat. 3 reported slight to modest increases, and 2 districts reported slight declines. Many districts reported lower employee turnover rates, and more applicants for open positions, labor market weakening, consistent with ADP. Comments about uncertainty delaying hiring were widespread. Makes sense. All districts described lower labor demand, citing declining hours worked and overtime. So declining overtime, declining hiring, or excuse me, not declining hiring, hiring pauses. So let me just restate that here. So lower labor demand, citing declining hours worked and overtime, hiring pauses, and staff reduction plans. Some districts reported layoffs in certain sectors, but those layoffs were not pervasive. 2 districts noted for many of their contracts, hiring plans had not changed since the start of the year. Wages continued to grow at a modest rate. Although many districts reported a general easing in wage pressures, a few districts indicated that the higher costs of living continue to put upward pressure on wages, right, and downward pressure on purchasing power. So I really want to get hyper-focused here on the labor market, and because I think that's really the last piece of the Jenga puzzle, if you will. I believe that this cycle is going to play out the same way that all these cycles have played out going back to the 1960s or so. Now, the timing, who knows? This cycle has gone way longer than I thought it would. I definitely, as far as timing, I definitely got that one wrong for sure. But I don't know that you can say that we're out of the woods yet, because let's face it, the large portion of the yield curve is still inverted. So if we had a booming economy, you would not see the 10-year trading at 4.4 and the Fed funds trading at 4.33. That's not a healthy economy. That's not how it works, right? A healthy economy is when the 10-year treasury is trading at 100, 150 basis points or more above Fed funds. So this is kind of where we've been for a long period of time. And I think the treasury market, if you want to just look at the yield curve exclusively, has definitely predicted what has happened in the global economy extremely well. And that makes sense because the treasury market is kind of the bond market for the entire global economy because of the monetary system and whatnot. But the question is, can the United States remain this outlier, or do we go the way of Germany? Do we go the way of China? Might not get that bad because they're really, really hurting. But do we go the way of Canada? Do we go to the way of South Korea? Do we go the way of Australia, New Zealand? And I'm referencing all of these banks. The Swedish central bank, I think, just lowered rates as well, where all of these central banks are kind of in unison dropping rates, where 6 months ago they were all, higher for longer, higher for longer. They were regurgitating the exact same narrative that we hear out of Jerome Powell and the Federal Reserve right now. But then, 6 months later, it's drop, 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 drop. And my base case is we're going to get that in the United States as well. I also said on that Twitter Spaces this morning, I don't know why Jerome Powell wouldn't cut rates. I don't know. From this standpoint, I totally agree with Trump. I totally agree with him. What are you doing, Jerome Powell? I mean, I get it. You're worried about inflation, but even if the tariffs increase the price of some things, and we see that in the Beige book, that some businesses are worried about that, it doesn't mean that it leads to an acceleration of prices. So it's just an adjustment of prices. And by the way, is the Fed holding rates at 4.3% somehow going to decrease the price adjustment that we have from tariffs? No, of course not. It's not going to do anything. So why would you not start dropping rates? I don't know, but we'll have to see how this plays out. I think the Fed is going to go from increasing rates too late to decreasing rates too late. And I think Trump's name for Powell may stick. Too late Powell, isn't that what he calls him? Yeah, I got to agree with Trump on that. That's for sure. Okay, now let's go over to markets and see how they are responding to not just the Beige book, but they really responded to that ADP report that came out. So we've got the Dow. Let me just refresh to make sure we're okay. So we got the Dow. Yes, it is closed down. 90, 100. So not much movement here. S&P pretty much flat. NASDAQ, pretty much flat. We got the VIX 17, a little high, but below 20. So that's good. And let's go over to bonds. This is where you're going to see the big move here, guys. So zoom in on a chart of the 10-year Treasury. And let's go to a 5-day chart. And you can see this wet and wild right here. And that's when the ADP number came out. We were at 4.6, and we just crash all the way down to where we are right now, about 4.35. So down about 10, 11 basis points. That's a big move in one day, as you guys know. And so before we move on, I want to just use this to emphasize a point I make on this channel all the time. It's what I was talking about at the beginning of the video, where what was this decline a result of? Did we have some news this morning that the deficit shrank, or that the United States debt went down? Or did we get some big news that the Chinese central bank started buying treasuries on net balance again? Did we get some sort of news that would lead the market to believe that there's going to be lower supply of treasuries moving forward? The answer is no, of course not. What we got is crappy jobs numbers. So if we get crappy jobs numbers, what does this tell the marketplace about future growth and inflation? Well, that it's likely lower than it was before 8:30 this morning, Eastern time, when these numbers came out. You see, so I want to emphasize the point here that the long end of the curve, especially, has nothing to do with supply. And I know it's extremely counterintuitive, but just forget the deficits, forget the debt in terms of the long end of the curve. Now, are the deficits and the debt good? Absolutely not. Absolutely not. We definitely want to reduce government spending. We definitely want to reduce the deficits, for sure. But that's because the government spending distorts the economy. So the problem is in the real economy. It isn't necessarily in the treasury market. And this is just a perfect example of that. That what really drives it is it's not supply, because right now everyone knows, including everyone in the treasury market, the supply of treasuries over the next 5 years is going to explode. I think a lot of people are under the assumption that the only reason the 10-year treasury is trading at 4.35% is because the treasury market just hasn't woken up to the fact that deficits are going to explode and the debt's going to be higher. I can assure you the treasury market understands this just as well as you do. I can assure you the treasury market understands this just as well, if not better, than anyone on social media. It's just they don't care about the supply. They don't care about the deficits. They don't care about the debt. The only thing they care about is growth and inflation expectations. Why is that? Because the major driver here, guys, is the commercial banking system. And they're pocketing a spread. It's an arbitrage. And so I won't go into the details there. But this is why when you zoom out, go back to 1950. Try to find a time when the long end of the curve over the span of a year or two was really impacted by debt and deficits. You're going to struggle because there isn't a time. And that goes back 75 years, right? But what you will see is that there's a strong correlation between the 10-year treasury and nominal GDP. In other words, growth and inflation. And we just see it playing out right in front of our eyes. So it's just one of these things that really frustrates me because it leads so many retail investors to inaccurate conclusions that somehow we're just going to get rates blowing out because the deficit and the Fed's going to have to do QE. No, they might do QE, but they certainly Wouldn't have to. And another thing that I want to highlight here, and then we'll move on, is interest rates don't control the economy. Because I hear a lot of commentators out there saying that, oh my gosh, if we could just get interest rates down, then this would be a big boost to the economy. And Scott Bessent is like hyper focused on getting the 10-year treasury down, not just because it reduces the deficit, because it decreases, the interest rates when we have to roll over the debt. We all know that story. But because if we get these interest rates down at the long end of the curve, this is going to trickle into the economy, and this is going to stimulate the economy. So this goes back to the idea that somehow the central planners can manipulate interest rates because they're not really about growth and inflation expectations, right? It doesn't work. It doesn't work. Look at QE 1, 2, and 3. Perfect example where the Fed did QE and interest rates went up. Why? Because growth and inflation expectations increased. So the main takeaway there, or the main point I'm trying to make, is interest rates at the long end of the curve, especially, don't control the economy. They are a reflection of the economy. Therefore, Scott Bessent or Donald Trump isn't going to be getting the interest rates down at the long end of the curve. And if they do get interest rates down, or if interest rates do come down, it's not because the economy has been stimulated. It's not because growth and inflation expectations are increasing. It's because they are doing the opposite. They're decreasing. So what we should want is higher interest rates. That's what we should want. We should want the Fed funds at whatever, call it 4%, and we should want the 10-year treasury trading at 6%. Now, a lot of people, that would devastate the economy. No, it wouldn't, because that means that the economy is doing really, really well. And if the economy is doing well, then 6% interest rates are no problem. Because let's say you're that real estate guy that now has to have, that now has to absorb these 6% interest rates. You don't care about that because you're increasing the rents, because all of your tenants are making more and more money because the economy is doing well. What you don't want is 3% interest rates, where the unemployment rate goes up to 8%. And now all of a sudden, none of your tenants can pay the rent. See, do you prefer the 3% or the 6%? Well, I'd take the 6% if I'm that guy. See, so again, interest rates don't control the economy. They are a reflection of what is happening in the economy. Okay, enough of that. Let's get over to gold. And one of my favorite topics, the gold miners. So gold, what do we do today? All right, up a little bit, up $20. We're almost at 3,400. And oil, coming back down. We had that big issue with Russia and Ukraine, which I think we had kind of that spike. I think that's why we got a big spike the other day in gold as well. And now we're kind of coming back down as the dust settles and as the market remembers that the demand side of the equation is likely going down. We're getting closer to the 50 handle. And especially when you look at the amount of supply decreases they've had over the last year and a half, although they're, increasing output, it really tells the story about what's happening to demand and what's happening to the global economy. Let's go over to Bitcoin at 104. See, this really surprises me. And this is something I totally got wrong. And if you guys are Rebel Capital's Pro members, you know that I actually put a bet on that Bitcoin would keep going higher because we had this fantastic breakout above these resistance levels at 106, where we got to 110, 111. And I was way up on the trade, but for like a day or two. And then it went down and it broke back down through the 106 level. And I, of course, immediately sold and took a loss on that one, unfortunately. And so this one surprised me, really surprised me. The only thing I can think of is maybe it was hype just before the Bitcoin conference. And then it's kind of like buy the rumor, sell the fact. So we'll have to see, how this keeps, what the price does over the next few weeks, especially if we start to see the labor market soften. Okay, now what I want to do is go on to my favorite topic recently, which is the GDXJ. And I thought I had a chart up of the GDXJ. I guess I don't. Let's just go GDXJ. Here we go. Yeah, boy, talk about a great looking chart. I mentioned this the other day, how I was talking to Hugh on an interview on the Rebel Capitalist Interviews channel. And one of his favorite strategies as a hedge fund manager is when he would see something really consolidate over long periods of time and then see a big breakout. And man, that's exactly what we've seen. Let's go all time here. Look at that. So we see this consolidation. We see some breakouts here, but we didn't see the big move in gold that would precede this breakout. But now, as you guys know, we've seen a big move of gold that's dramatically outpaced the miners. And we'll have to see. Maybe there's another false breakout again, and I get it wrong. But this is definitely something I'm watching very closely, that's for sure. Now, if you are a gold investor, which if you're not, what are you doing here? What on earth are you thinking? I want to talk about the sponsor we've had for a couple months, my good buddies over at Monetary Metals. I know the owner, Keith, extremely well. And can we pull up my account? Nah. Now I got to log in. But basically, I've got about $40,000 roughly of gold at Monetary Metals. And I've had it there for about 2 or 3 months. And I've had a great experience. And the neat thing about Monetary Metals is you not only get paid on your gold, but you get paid an interest rate in gold, not just fiat dollars. So the way they do this is they have gold leasing programs with jewelers and other counterparties that are trying to hedge the gold they have in the form of the jewelry or the gold that they have in their inventories, and they're willing to pay 4, 5, 6% for that. And so the Monetary Metals kind of acts as a middleman there. So if you've got some physical gold that you're paying 1 or 2% for, and you're sick and tired of this negative carry, and you actually want to get paid an interest rate on your gold, I would strongly suggest checking out Monetary Metals. It's monetary-metals.com/gammon, I think, is it, Josh? You can go ahead and put that in the chat. And if you want to know more about their business model, Josh will put a link to a whiteboard video that I did explaining their business model in the description of this video. You can check that out. And if you do have any further questions, don't hesitate to call the guys and gals over at Monetary Metals. Just tell them that you watched one of my videos and you've just got some questions, and they're happy to go ahead and walk you through it. Okay, so then getting back to the GDXJ, what I'm doing right now, guys, that I'm really excited about is I'm actually taking the total stocks, and actually I can kind of share this with you guys. That might be fun. You can see what I'm doing. So, oh, that's not what I want to show you. We can go ahead and just go over here. So what I did is I had one of the GPTs that I've trained go over and tell me the list of miners that make up the GDXJ. And here they are right here. So, and it's by weight. So it starts with Evolution Mining and Alamos. Evolution is 6.63. Alamos is 6.09. And what I would do, because I just don't have the time to go through the analysis, the bottoms up analysis on every one of these companies, is I would just buy the GDXJ, which I did the other day, just starting a small position just for the sake of disclosure and transparency. But I wouldn't have time, so I'd just take the beta. What I'd like to do is really get focused and have some more upside there if my thesis plays out. And what I think we can do now, and what I'm trying to do, and just go through the process, is have AI actually analyze each and every one of these companies based on their last, call it 2 or 3 quarterly reports, and then give me a summary and a breakdown of Evolution versus Alamos as an example, and then as my research assistant, tell me which stock they would select to outperform over the next 6 months. And so I'm just playing around with this right now. I'll share some of the results with you guys when I get them. I'm thinking of putting this into a report that might be ready by next week that you guys can have for free, of course, and that dives into at least those first 2 companies and shows you kind of the pros and cons, what's going on their balance sheet, what's going on with their debt, what's going on with their cash position, all the fundamental analysis that you would want from a junior miner. And then kind of the short and sweet as to which one I would choose or which one the AI would choose. I'll tell you if I agree with the AI or not. But that's kind of what I'm doing behind the scenes here, because as you guys know, usually the gold price moves and then you get the miners coming in, you get silver coming in, and they kind of follow. But at the end of the cycle, they usually go up a lot more than the underlying metal. And I'm a cycles guy, and I'm a guy that likes to look at history. And if something's happened 95% of the time over the last, 50 years, I think there's a pretty high probability that it will happen again, assuming that there's a mechanical reason for it happening to begin with, and it wasn't just completely haphazard, which I don't think this is. I think there's a definite mechanical reason as to why gold moves first, and then the miners typically move second along with silver. So on that bombshell, guys, enjoy the rest of your afternoon. Make sure you're standing up for freedom, liberty, free market capitalism. We're going to have to pay very close attention to the jobs numbers we get on Friday, the non-farm payrolls. And if you have gold, physical gold, and you're looking for an alternative for storage that actually pays you gold, there you go, Josh. Thank you. monetary-metals.com/gammon. And you can watch that explainer video for their business model in the description of this video. And on that bombshell, guys, we'll see you in the next video.